Imagine going into your bank and being told that you can't get your money out.
They just came out and told us that the bank is shut down.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run.
Silicon Valley Bank, SVB, is part of the tech establishment here, propping up new ventures. It's been the bank for startups for 40 years, and it collapsed in just 48 hours. On Tuesday, there was no outward sign of a problem, but then a surprise announcement from the bank on Wednesday. They needed to raise more than $2 billion to offset bond sale losses. They'd failed to manage sudden interest rate rises. The 16th largest bank in America, failing in real time.
Hey, Amy, you got any money in the bank? You better hurry.
George, let's not stop. Let's go.
A minute there. Uh-oh.
Please, let's not stop,
I'll
George.
be back in a minute, Mary.
I'll take mine now.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
We wired out the money yesterday, but Silicon Valley Bank did not honor our wire. So we were not able to move any of our cash out of our bank account.
It's one of the largest bank failures in history.
It's the largest banking disaster since the 2008 financial crisis.
Why? Well, it's very simple, because we're cutting in on his business, that's why. And because he wants to keep you living in his slums and paying the kind of rent he decides. Can't you understand what's happening here? Don't you see what's happening? Potter isn't selling, Potter's buying. And why? Because we're panicky and he's not, that's why. He's picking up some bargain. Now, we can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
But my husband hasn't worked in over a year, and I need money.
How am I going to live until the bank opens?
I got doctor bills to pay. I need cash.
We are in a banking crisis, and we don't know where it's going. It is a fast-moving situation. An hour ago, the president addressed the crisis and said this:
Americans can have confidence that the banking system is safe.
We mustn't panic. We mustn't panic.
Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
That's generally how capitalism works, and luckily they aren't going to bail out the investors that are actually invested in the equity of the bank. But the FDIC is only supposed to insure up to $250,000 worth of deposits, and with them having to insure all of the deposits of the bank, and with 90-something% of SVB's bank deposits being uninsured, this could definitely deplete a lot of the funds that the FDIC actually does have, and a lot of the money that he was just saying that banks have been paying into that fund. As more banks, including Signature Bank, continue to collapse and they continue to insure all of the deposits, even the ones that aren't supposed to be insured, eventually the FDIC could run out of money, and then as these insurance funds need more funding, obviously that money is going to come directly from the Fed. That undoubtedly means more printing, obviously, and that's why all of cryptocurrency has been on the rise today. In the past 24 hours, Bitcoin is up 13.25% at the time of recording, and stuff like bank collapse, bank run, and buy Bitcoin have all been trending on Twitter for the past couple of days.
Fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable.
The reason why this happened is because interest rates have been too high. A lot of these banks had long-term treasuries, and that means that the value of those have been going down. If they held them to maturity, then they would have been able to get all of that money back. But as people started to run on the banks, they had to sell those assets to try to get the money and then pay the depositors. Unfortunately, with interest rates being so high, all of those long-term bonds had dropped drastically in prices. And with them having to sell them before maturity, they took huge losses, and this could be a problem with many more banks. Also, as these banks collapse and they have to liquidate all of the assets, all of the bonds that they held and the assets that they also held are going to go onto the market, flooding the market with more things that people just can't afford to buy right now and causing an extreme bout of monetary tightening. This is at the same time that the Fed is trying to reduce their balance sheet by selling bonds and mortgage-backed securities onto the market, and with banks doing the same thing and no one trying to buy them already, this is going to lead to a financial crisis that the Fed is going to have to print to get out of. So while this may have delayed the crisis, and while people might actually believe the government and think that they will have their money available when they try to go to the bank, if the FDIC does start to run out of money, eventually the banks are going to still collapse. This is just delaying the inevitable collapse that Bitcoin was actually created so that we could opt out of in the last financial crisis. I think people are starting to realize this now, and that's why the markets are starting to pump, except for obviously bank stocks. Because as I keep saying, people know that the government is not going to stop spending, and there's no way that they're going to be able to raise taxes as the economy is just collapsing. Taxes are made by economic development, and people actually have to have a profit for it to be taxed and for the government to have some income. The only other option is for the Fed to print money, and that's the inevitable outcome of a crisis just like this. So the government has guaranteed all of the depositors all of their money back, and that means that no taxpayer should supposedly pay any money. But the mainstream media is saying that this isn't a bailout. So let's see what's up with this bailout that's not a bailout that might end up leading to bailouts anyway.
The U.S. government just bailed out Silicon Valley Bank, and if you're a regular working American, this should make you very upset. Because according to CNN, the Biden administration on Sunday guaranteed that the customers of Silicon Valley Bank will have access to all of their money starting on Monday. And what that means is that the White House, the Federal Reserve, and the FDIC is guaranteeing over $150 billion in uninsured deposits from wealthy tech executives and tech companies that were sitting at Silicon Valley Bank. This is,
like I said, that was more than 90% of all of the deposits that the bank held at all. So while the FDIC would have had to insure about $1 billion or a couple $1 billion worth of deposits, now it's actually on the hook for more than $100 billion worth of deposits. Also, with this being the second biggest bank to ever fail in history, how much money does the FDIC actually have to bail out banks if they're prepared for the worst, and the worst was just one bank that failed that was bigger than SVB? I think that if we see this crisis cascading into other banks and we actually start to see bank runs and bigger banks and more banks across the country, then eventually, like I said, the FDIC is obviously going to run out of money. And where the hell is that money going to come from? It's obviously going to come from the Fed.
Is unprecedented, folks, because the FDIC federal insurance deposit limit is $250,000 per bank account. And that FDIC deposit limit was meant to protect regular working Americans in the case of bank runs. But now they're expanding that to say, well, no, it's not $250, it's unlimited in the case of Silicon Valley Bank, because the government determined that they were a systemic risk factor that could cause contagion across the US banking system. And ultimately, the government and Janet Yellen at the Treasury and Jerome Powell at the Fed, they might be right about that. As I said in my video on Friday, there is lots of systemic risk in the banking system right now. However, that does not excuse the government giving all the depositors from Silicon Valley Bank, who are basically rich people and rich tech companies in California, a free pass. They should have taken a haircut. Whether it was 10% or 20%, they should have lost something. And the fact that they didn't means that, once again, the US government is encouraging moral hazard and risk-taking in the financial system with no repercussions. Now,
True, this doesn't really incentivize people to do the extra work to take care of their money if the government is just going to reimburse them if they lose it anyway. The Silicon Valley Bank obviously didn't take into account interest rate risk, and interest rate risk can turn into credit risk. And with us setting precedent that banks don't even have to do hedging or they're going to get bailed out, then why shouldn't these banks just take max leverage or do YOLO plays and try to make as much money as they can? Because if they fail and they collapse, then the government is going to come in and save their butts anyway.
minutes, I'm going to explain how this bailout is going to affect you as the regular American, particularly in regards to the Fed printing money into inflation or potentially deflation. But first, I need to explain how this bailout works so you can understand it. Number one, the Federal Reserve is promising to print money to make sure that all the depositors of Silicon Valley Bank can take out all the money if they want to this week. They're going to be allowed to do that because the Fed is going to print as much money as it takes. But number two, in the process, the FDIC is basically selling off all of Silicon Valley Bank's assets. And as they sell off the assets from Silicon Valley Bank, the FDIC is going to pay back the Federal Reserve whatever they had to print in order to cover withdrawals from Silicon Valley Bank. So net, the Fed might not actually be injecting too much money into the economy since the FDIC is going to sell the assets from the bank and then pay the Fed back. And so in the short term, this might be crisis averted. We'll have to see what the markets do this week. I wouldn't be surprised if a lot of them think that the situation is solved and that we're not going to.
I think that all of those assets going onto the market is probably going to have some negative effects that could bring down other banks. If that does happen, then the Fed is going to have to step in, and they're not just going to be printing money to give to the FDIC to inevitably be paid back. Eventually, it's just going to be printing, and there's no way that they're going to get paid back. They're just going to be trying to pull us out of a crisis that they don't really have any leverage to pull us out of anyway, especially since we're just starting to feel the effects of all of these long and variable lagging interest rate hikes that are finally starting to have an effect on the market. And it looks like if it is true, like everybody says, that these interest rate hikes have a lag of about 9 to 12 months, then we're probably just now starting to see the first of the 75 basis point interest rate hikes, and we're going to be slammed into about 3 or 4 more times by more 75 basis point hikes, and then another 50 and a 25. So even if the Fed was to cut interest rates right now, I think that as these interest rate hikes do work their way through the economy, and we're dealing with a crisis in the meantime, it's just going to make the crisis worse, and there's not going to be much that the Fed can do to pull us out of this situation.
See other issues in the financial system going forward. But here's the problem, folks, is that Silicon Valley Bank was the canary in the coal mine on the U.S. banking and financial system. And even though the Fed and the U.S. government acted quickly to bail them out, I do not think this is going to necessarily prevent future bank runs. And that's because,
especially with Biden just saying everything is okay and the Treasury basically saying the same thing. They're just saying that, oh, we've got the FDIC, but people don't really realize that the FDIC has a limited amount of money. Also, that they're not even supposed to be bailing out 90% of the money from this bank. And with it being the second largest in all of history and the third largest signature bank just collapsing over the weekend, I think this might put a pretty big dent in all of their funds. Then whenever more banks start to collapse, who's going to come in and save them? I think you can answer that question.
the root causes of this bank run are still not addressed. And the number one root cause is that the money supply is contracting in America right now. As I showed you in my video on Friday, it's contracted by 2% year over year, the M2 money stock, which is the first time that's happened in 100 years. And the only other times money supply has ever contracted, we've had a depression and huge runs on banks. And so 0%. Back in March 2020, when the pandemic hit, the Federal Reserve Board of Governors reduced the reserve requirement from 10% to 0%, which means that the Fed is not requiring commercial banks to hold cash reserves. Normally it's 10%, they have to hold 10% cash reserves either on hand or at the Fed. There is no such requirement right now. And again, it's amazing to me how not a single article I read over the weekend mentioned this. So long as banks continue to not be required to hold cash reserves by the Fed, I suspect we're going to see other bank runs and issues in the banking system going forward. Now,
especially because usually if the FDIC would have to bail out a bank like this, then there would be 10% of assets on hand that would help them with the redistribution process. But right now, that's not even there. And like I said, they're going to bail out another 90% of all of the people that had uninsured deposits. I'm pretty sure that the FDIC was planning over the past 10 years for probably there to be at least 10% of assets on hand at the banks if they did fail and they had to bail them out. Also, they weren't expecting to have to insure deposits that weren't supposedly being insured over $250,000, but now they just have to insure everything that the bank had altogether.
We need to clarify something, everyone. There's a lot of confusion out there. I called this a bailout. Other people are saying this is not a bailout. For instance, Janet Yellen is saying that a bailout of Silicon Valley Bank itself was not under consideration. She says, let me be clear that during the financial crisis, there were investors and owners of large banks who were bailed out, and the reforms that have been put in place means we're not doing that again. But we are concerned about depositors and are focused on trying to meet their needs. And so what does that mean? Why is Janet Yellen saying this is not a bailout when very clearly the depositors got bailed out? Well, yes, the depositors got bailed out, but the people who own stock in Silicon Valley Bank, the shareholders, they are not getting bailed out, which is good.
So essentially what it's saying is that Main Street got bailed out, but Wall Street is not supposed to be getting bailed out. This is definitely different than what happened in the 2008 financial crisis because they just bailed out the banks and the equity and everything, and then they expected that if the banks were still there, then the depositors would still have their money. But now they're just trying to bail out the depositors and let the bank actually go down. But in 2008, we did just ignore the Lehman Brothers situation, And it just kind of cascaded and snowballed into a bigger crisis with more banks collapsing. And then eventually the whole government had to come together and bail out everybody. And then they printed about $1 trillion to bail all of those banks out, all the while complaining that they couldn't print $1 trillion because it would totally collapse America. But now we're $31 trillion in debt, and apparently that's just fine. So as they continue to kick this can down the road and act like there's not a problem, eventually we are going to hit a brick wall, and there's not going to be anything that the government can do about it. For that reason, that's why I have my money in Bitcoin, because it's not a currency that can be manipulated by a central bank. And if there is a crisis, then people are going to lose their money, but there's not going to be a bailout of people that were irresponsible, so that people that are actually doing the right thing with their money will know that their money is going to be right where they left it.
As taxpayers are bailing out these banks for no reason. You want to bail out somebody, you bail out the depositors. But if a depositor was over deposited and didn't have the right breakdown throughout their accounts to be covered by the FDIC insurance, then that should be on their own responsibility. It shouldn't be my responsibility to bail out a depositor who's over deposited or a bank that is failing. This is the problem in the system, that they allow so many scams to take place throughout the banking industry. You know, when a bank borrows money, they talk about the Fed funds rate. That's what banks borrow from the Federal Reserve at. You know, they can take and borrow, let's say, $1 million, okay, as a liability, but they can then, through accounting, turn that liability to an asset and then lend out $10 million against that $1 million debt that they took in. So they're dramatically over leveraged. And until we get a system that allows true auditing by a real forensic accounting firm, not the Federal Reserve, we are going to have these problems over and over again, because they continue to allow and come up with this statement that these banks are too big to fail. And the question.
He was talking about fractional reserve banking, and that is why our banking system is totally over leveraged. And while that is how we got into this situation, it's not currently what's going on right now, because at the beginning of the pandemic, they actually reduced the reserve rate to 0, so they don't have to have any reserves on hand. And now if anybody goes to the bank, then who knows how much money they actually have. And as the monetary supply continues to contract and people need their money, they're going to go try to pull it out of the bank. And when they realize it's not there, we're going to be probably seeing more bank runs.
The question is, why should any American citizen have any bank being too big to fail?
I think that's a very good question. And it's interesting the wording that the Fed used on their press release on Sunday. They said no losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. But as you're mentioning, you know, the money has to come from somewhere, and you might be diluting the dollars the taxpayers are holding, or it might be coming directly from the taxpayer. At some point, the taxpayer is going to be bearing the burden of this. Your perspective on where we go.
Thank God, I think people are finally starting to realize this, and that's why assets like Bitcoin and other cryptocurrencies are skyrocketing today.
Go from here. A lot of people are worried about contagion throughout the banking industry, further banks failing. We have the former FDIC chairman coming out saying that, you know, it's very possible more banks could fail after this point.
Oh, I think there's no doubt, Elijah. Look, as I've said many times, the banks are over leveraged. So this is the issue that has to be resolved, that we have to quit bailing out failing businesses. Nobody bailed out my business when it failed. Why should anybody else? Why should a bank be too big to fail? That's the issue. And really, in the crux of the matter is that there's too much forgiveness to big dollars and not enough to the little dollars. And of course, are allowing these banks to get so far deep over leverage without doing an actual auditing or an accurate accounting of what's going on in those banks.
So in summary, basically, America used to be a nation of hardworking individuals who really cared about their value of their money. And now it's just a giant daycare where if your business collapsed, then the government is just going to come give you a big hug and give you all of the money, taking it away from other taxpayers. I don't know about you, but I don't really need to be living in a daycare. I'm an adult and I make responsible decisions with my money. However, if I'm mistaken and I make some bad decisions and I lose a bunch of it, I don't expect anybody to come bail me out, because I knew I was taking a risk in the first place.
In my opinion, my 50 to 70% sell-off is going to come, and it's probably going to come faster than I thought, because this is only the beginning. You know, this is just starting right now. And we all tend to forget what happens in history and how these markets break. And then what will happen is one day the markets will be down huge. They'll mark that day in history, like October 19th, 1987, and so on and so forth. When really, the markets are telling us right now, the industries are telling us right now that there's a lot of trouble out there. The one-day rally means nothing. But everything that you look at is telling you that there are massive amounts of trouble in the economy and with what's going on. And at the end of the day, it's got to collapse, because that's the only way it's going to resolve itself.
Now, it seems like at least the precious metals are understanding what's happening right now. It seems like they're going vertical right now.
So are the cryptos. This is now making the case for cryptos at the same time. Yes, the precious metals are going parabolic, but don't forget, okay, that the precious metals were under heavy pressure and silver was back almost at $20. So the rally there is also, in my mind, in silver, more of a short squeeze for now. It doesn't mean it's not going higher, because I do believe it's going a lot higher. Gold, I told you that I thought we were going to make new highs this year. So there, I'm not at all surprised. But the cryptocurrencies are telling another story as well, because now people that are hopefully getting frustrated with the ridiculous banking system that we run under and a stupid Federal Reserve, they're now running into this crypto world. Now, again, this may be a one-off day. I can't say this is the official. Cryptos are good too, but I do like cryptos. I do believe it. And I think that if you're a libertarian, you've got to be a fan of cryptocurrency, because there is no central bank intervention.
So basically what he's saying is that right now people are starting to realize that hard assets are going to be the only way to escape inflation as the Federal Reserve continues to print money and debase the dollar out of existence. But there is probably still some panic coming along the way before we do eventually go parabolic for good. And as people do panic, they're going to probably need money. And if they can't get money out of the bank, then they might just turn to cryptocurrency and other assets, which could send them plummeting as people just fall into deep panic. But that's just going to be short-term emotion, because in the long run, people are going to need real sound money in order to continue living their lives. And the only place to get that is going to be hard assets, like I keep saying, including Bitcoin and other cryptocurrencies that are decentralized, and gold and silver.
Now, the interesting thing about cryptocurrencies is at least these banks seem to be tied a bit to cryptocurrency, especially Signature Bank, I believe, funding a lot of the startups there. What is your perspective on that? And do these bank failures mean anything? Does it give you any concern regarding the cryptocurrency sphere?
None.
What it means to me is that you shouldn't keep your money in a centralized exchange, because they might actually have some of your money sitting in a bank instead of actual cryptocurrencies. If the centralized exchange goes down, then they are probably going to be using your assets for settlement of bankruptcy liabilities. And this means that if you have your crypto and your Bitcoin and everything in an actual cold storage wallet, like you're supposed to, then you're going to be safe. But the whole point of cryptocurrencies is to escape the banking system. And if you're keeping your money in a centralized exchange, then you're just participating in the whole system that Bitcoin was created to opt out of in the first place.
None whatsoever. Again, a bank makes a bad investment. That's one story, right? We saw what happened with Sam Bankfine and that whole fiasco. And again, we have to really find out what the real details are. But the true cryptocurrencies, the Bitcoins, the Ethereums, and some of the ones that are near the top that carry over a $10 billion market cap, they seem to be realistic and real. Again, we have to remember, we have to separate out. There's 13,000 and some cryptocurrencies out there. Half of them are phony, or more than half of them are phony.
Most of them are centralized. The things you want to be invested in is decentralized cryptocurrencies, where the community actually has control over the future of the project.
Scam money. But the real ones, which are seeing the action, look to be real, and they would not be taking the banks down right here. The banks would be taking down on very high speculative loans on stuff that would be the potential home run type hits, which may never come.
No, I think the average person out there might be kind of shocked, and it may have not even hit them yet, what is happening in the banking system. I mean, you see, as we're talking about, the second and third largest bank failures in the US just happened pretty much over this weekend. Can you walk us through, like, how is this going to be impacting the average person out there in the days and weeks ahead?
To right now, in zero effect. But again, if we do get a run on the bank, that's always the concern. But that is a problem that is self-created when you get too far over leverage to what your assets are on hand. And that's the problem with fractional banking, because it prints money. It's another way of printing more money and devaluing currency is really what it comes down to. But we could see, look, this is only day one. And right now, I'm sure many small investors are just in shock and don't understand why the market's up right now. Don't understand any of this. Okay. Versus as we get going and after this rally, let's see how the week plays out and see where we go. I mean, this could be over in 10 minutes and we could be down dramatically. It could be over later this week, or maybe they're going to really flatten out and stabilize everything. I don't see that. I don't see stabilization. I see a big problem. I see lines up at the bank, people trying to get their money out. And I bet you can bet this, that there's people right now that have some intelligence to markets that are taking their money out of the banks right now as we speak. And not just those, but many of the banks, even at JP Morgan, Citigroup, any of them, because who knows who's really in trouble. They wouldn't all be in trouble, which is the same thing that happened in 08, but they didn't want to disclose who was in trouble. So they forced them all to take the TARP money.
Those are some great points. And like he said, a lot of people are trying to figure out what's going on right now. And as they are trying to investigate the bank collapses and trying to figure out what to do with their money, All of us already have a head start because we've been learning about cryptocurrency for the past few years. If you're watching this video right now, then I'm sure you've probably been in the crypto market through the bear market, and you already know the significance of Bitcoin and other cryptocurrencies that can save us and let us opt out of the banking system and this collapse. All of these other people, after they finally figure out what's going on with these banks, they're going to have to do a bunch of research and figure out about Bitcoin and other cryptocurrencies, and that's going to take time. While the rest of us were already in the market, and whenever all of the rest of them get in the market, we're all going to be ahead of the game. Like I always say, the government is not going to quit spending money because that's obviously just laughable. And as he just got done saying, the fractional reserve banking system is just another way for them to print money. So even though the Fed is trying to tighten the money supply and reduce their balance sheet, there's no way that they're going to be able to bring down inflation to 2% because we have $31 trillion in debt that aren't going to be serviceable with interest rates at 5%, and the federal government is not going to quit spending money, and the banks just don't care about us either.
Listen to Democrats, they won't even vote for this. In the next 10 years, we will pay as Americans, the hardworking taxpayers, over $10.5 trillion on interest. This is interest on the debt. To put that in perspective, since 1940 till today, in the last 80 years, we've only paid $9 trillion in interest. That is why this budget is not serious.
Biden proposing his massive $6.8 trillion budget last week, reigniting the debt ceiling debate, promising higher taxes and more spending. Republicans are slamming the plan. It includes more than $5.5 trillion in tax increases over the coming 10 years.
This is Ibisu. He's named after one of the 7 lucky gods of Japan. According to legend, he will bring wealth and prosperity to anybody who evokes his name. So don't forget to write his name in the comments or you'll bring dishonor to your whole portfolio. And check out this video right here. Say goodbye, Ibisu.